If you're watching this video, you've probably heard that it's really competitive in your local housing market, and you're looking for an edge to figure out just how you can win. It's also possible that you've already written a few contracts only to experience disappointment when your offers weren't accepted. You know, when I first counsel buyers that have lost several times, they often say they were outbid on the other houses. Their initial belief is that they lost to someone else because they offered more money, that their price wasn't the best. However, when I look closer, I often see the problem is actually a weak contract. The price may have actually been very competitive, but other factors like their contingencies or their timelines or the team that they had involved, that those just weren't in their favor. So in this video, I'm going to give you my top 4 tips for writing winning bids. I'll also give you a new perspective on the real estate contract itself, covering everything from price to contingencies to timelines and teamwork. By the end of this video, you'll know exactly how to craft offers that dramatically increase your chances of winning. Here's how the process normally works. You've been casually thinking of buying a house for about the past 6 months. You may have even had an initial conversation with a realtor or a mortgage lender. It's Thursday, and you see a new listing pop up online, and you instantly know that that is the one. So you see there's an open house on Saturday or Sunday, and you decide to swing by. And when you get there, you see that the open house is absolutely packed. And the seller has called for an offer deadline of Tuesday at 12 o'clock. So because it's the one, you move really quickly. You call your realtor and you start hearing things like waive contingencies, close quickly, escalation clause, rent back, free rent back. And then you just feel completely overwhelmed. You write your offer as best you can in that very moment of time while trying to digest everything being thrown at you, and you lose. You know, for most people, it can take 4 or 5 offers before they actually win. But why exactly is that? You know, with each offer they write, they generally get more comfortable with the risks of writing more aggressively. But the question is, if they really understood everything before they wrote that first offer, would they have won right out of the gate? You know, I believe that when you're able to review everything in a very unemotional, calm state, like right now, when you have that time to digest all the risks and all the moving parts, you can move forward with confidence. And that's the point of this video. It's to give you that time to learn the strategies, to discuss them with your realtor and your lender, so you can put your winning framework together for what's your best offer. You'll know exactly what it looks like. So when that perfect house comes along, you increase your chances of winning. So let's dive in. Competitive landscapes are known as sellers markets, whereas softer areas are often called buyers markets. You know, in a buyer's market, which we haven't seen for a while, the seller comes out begging. You know, what can I do to make you happy, to make you buy my house? Do I need to pay your closing costs? Do I need to buy your rate down, drop the price, finish the basement, like give you my car, right? What do I need to do? Like, what do you need to buy my house? Now, in a seller's market, it's the exact opposite. The seller is the king, and the people are begging and pleading to be the chosen one. You know, as you write your offer, I want you to put yourself in the seller's position when reviewing every single decision. A protection or an out for you is actually a risk for the seller. The seller always wants the most amount of money, pretty much every time, but they also might have a unique situation where price isn't everything. You know, I've had countless examples where the highest bid didn't win because the offer didn't allow for the accommodation that the seller was actually looking for. Now, for this lesson, let's assume that the seller didn't tell you or your realtor what their hot buttons were. You simply just need to figure out what your best and final offer would look like so that you can be in the running. And that leads me to my top 4 tips to increasing your chances of winning. The first tip, and likely the most important, is your pricing strategy. You know, if your price isn't in the running, everything else we're going to discuss in this video probably just won't matter. So when the seller gets multiple offers, I want you to think of them stacking them all up in one big pile from maybe highest to lowest price. And then they maybe grab the top 4 or 5 just to focus on those first, right? They're the highest prices. Do they give me what I'm looking for? And are these good enough? And obviously you need to be in that top spot or at least near it so that everything else we discuss in this video makes a difference. In competitive markets, it's not uncommon for a home to be listed much lower than actual market value. As an example, if a listing realtor or seller believes their home should sell for, let's say, somewhere between $625,000, $635,000, they might actually list it for $599,000. And this price, it ultimately attracts more buyers, gets more people into the open houses, and in most cases has buyers competing over the home and pushing those prices higher. In cases like this, your realtor is likely to discuss something with you called an escalation clause. Now that's a contract disclosure which gives you the ability to automatically raise your price to be greater than some other competing offer. These escalation clauses have caps, which is the highest price you're willing to pay, and an escalation factor, which is how much you're willing to pay over the next buyer. I wanted to think of shopping on eBay, not that everyone uses that anymore, but you're putting your purchase in the automatic auction. You basically say you want to pay one price. Let's just say $599 to match our example. But then you'll say, I'll pay $5,000 more than the next offer. That's the factor, but I won't pay more than $649,000. That's your escalation cap. Now, determining the price can be very tricky in some markets, especially in areas where inventory is very low and there just hasn't been that many recent sales. Now, generally your realtor will help you analyze the comps and come up with some type of pricing strategy. And we'll have more on this later. My second tip is your contingency strategy. I like to call contract contingencies only if clauses. I want to buy your house, but only if I like the home inspection, or only if my financing gets approved, or only if the house appraises for the price that I'm offering. When a contingency exists, it typically has a period of time that you select to clear them. And each one of those only if clauses, they represent an action which could cause the contract to fall through, at least in the seller's eyes. So if we jump back into the seller's shoes, they want the most amount of money, but that money on that contract is only good if it closes on time with those specific terms. Now, naturally, none of those contingencies existed. The seller would view that contract as same as cash, about as good as you could get. And it's easy for any realtor or lender to say, if you want to win, pay the most and waive all your contingencies. You'll hear that over and over again. And while that sounds risky, there are plenty of solutions to mitigate the risk. And I also want to make it clear that just because we're talking about these strategies, it doesn't mean I believe everyone should do this. Every buyer is different, every credit profile is different, every mortgage, down payment structure, housing type, and as a result, everyone needs to look at these objectively, using their personal situation before choosing to act on any of these ideas. Here are the top 3 contingencies that generally make a difference that you need to think through before you write your next offer. The first is the home inspection. This is where you bring a licensed home inspector to thoroughly examine the property. Their job is to identify items that need repair, highlight any deferred maintenance that requires attention, and uncover hidden issues like moisture problems, foundation concerns, and much, much more. When you have this contingency, it often gives you the right to back out for any reason, or at a minimum, try to open up negotiations for repairs. And while this seems very fair, in some markets, it's become a bit of a strategy to win, where people offer these really high prices and then they use the home inspection contingency to try and renegotiate. They strategically do that. Now, as a seller, I wouldn't want that, right? A home inspection, even if the house is perfect, it allows someone to play games with me. So as a result, I'm likely to go with someone that waives this contingency, completely eliminates my risk as a seller. Now, I'm not a fan of people buying houses without home inspections because I've seen too many houses, too many perfect houses come back with major issues. Fortunately, the industry has evolved to offer a variety of home inspections to buyers to use while writing their offer. That's right. People are actually paying for home inspections on houses before they even write their offer. Of all these strategies, I have found this one to be the most effective. The next contingency is your financing. This tells the seller that you will buy their home as long as your loan gets approved. Now, personally, I think this is the easiest contingency to waive, but it takes a little bit of work of you up front, and it requires that you work with a competent loan officer and mortgage lender. And we'll discuss that more shortly, but when I work with clients, we recommend getting fully underwritten. And that means a full review of your credit report, your income, your assets, and having a real underwriter approve your loan file. The key of what I just said there is a real underwriter, not a loan officer's intuition or some automated system. That's where all the big mistakes happen in mortgage lending. When you do this properly, the only risk of waiving this contingency is job loss. Lenders will verify your employment within a few days before closing just to make sure that you still have a job. Now, if you waive this contingency and you don't close because your loan gets denied, the seller can keep your earnest money deposit. So be very careful with this one. The last important contingency is your appraisal. I want to buy your house, but only if the house appraises for the sale price that I'm offering. So the issue with this one being in the contract is that it leads to doubt. especially in markets where prices are being pushed a good bit higher than some of the recent sales. When this contingency is waived, the seller knows exactly, as they accept that offer, how much money they're going to get on settlement day. If you're considering waiving this contingency, you need to have a conversation with your loan officer to talk about the possible scenarios of how a low appraised value will impact your loan. For buyers with large down payments, it might have no impact at all. And then for others, maybe you have a little bit of mortgage insurance added to your loan payment, or for some, maybe the rate is increased. There are plenty of cases where we tell buyers that they just can't waive the appraisal, because any reduction in value will lead to their loan being denied. For the buyers who can't waive this contingency, or they just can't justify the risk, another strategy is called the appraisal gap coverage. This is where you tell the seller that you're willing to pay some premium over the appraisal in the event that it comes in low, as long as it doesn't exceed the price on your contract, obviously. For more information on appraisal strategies, please check out this video that I've linked right here. Now, if waiving contingencies is not an option for you given your personal situation or risk tolerance, you can focus on the third tip, which is timelines. Your contract is full of actions, which those are your contingencies, and then your timelines, which is the time it takes to complete each action. And I want you to think of the seller just sitting there waiting for these timelines to be completed. If each contingency represents a risk to that contract unraveling, or you trying to renegotiate the contract and the price, you're likely to put those dates on your calendar and just think about them constantly, right? And then of course you celebrate the moment when those milestones are crossed off, because now as a seller, you know exactly what the final outcome will be. So if you can shorten that time frame of worry for the seller, they are more likely to choose your offer over someone else that might have extended timelines. When we say timelines, we include both the speed in which you clear contingencies, but also the speed in which you give the seller their money. In some cases, every offer is fully baked with contingencies, so the winner is often the person who can clear everything the fastest. If someone needs 21 days to finalize their financing and you only need 10, the seller would likely take 10 days of worry over 21. Now, every market is completely different. Every lender has different capacity restraints throughout the year, and every borrower has unique situations that leads to different timelines. Just know that speed in all scenarios can make a big difference. Speaking of speed to close is one that I've seen evolve over the years. There are many times when the seller has absolutely no intention of moving out quickly, but the speed to give the seller their money, or the speed to closing, is an angle that a lot of buyers are using. They basically tell the seller, I'll give you your money in 2 weeks, right? A 2-week close. But don't worry, you can live in the house for up to 60 days after closing. And in some cases, they'll say you can live there for free, meaning I, buyer, will make those mortgage payments. That's called a rent back, or in some cases, a free rent back. The last tip, and probably the most important, and of all the least recognized, that's your team. As the buyer, you obviously show up on closing day with the down payment funds, you sign the mortgage documents, you agree to the terms of the contract, but it's the team representing the buyer who is there to help fulfill the contract. The realtor community is one that is built on relationships. And when contracts get competitive, the listing agent likely informs the seller who they believe is the most dependable and known for getting things done while maintaining high ethical standards. This reputation involves the affiliate partners as well, right? The home inspector, the title company, the mortgage lenders. They not only carry a solid reputation, but they demand the highest of others that support that contract. When all is equal, don't kid yourself. The realtor with the best reputation, that's the contract that wins. Earlier, I said the price you offer is the biggest key to winning, but choosing that price can be very tricky. The realtor that you choose needs to have the skill to analyze the market behavior and the comps to help you come up with a pricing strategy. But unfortunately, that's where many deals are lost. Right there, just figuring out what price to submit. Now, you may really like that realtor. It might be a close friend, it might be Aunt Susie. But I will say, the more competitive the market, the more you need a top realtor on your side, and certainly not someone that treats real estate as a hobby. Your lender is another huge consideration in the team category. The listing realtor will likely want to know that your lender has a solid reputation in the market for closing loans on time, meeting demanding deadlines, and obviously having a reputable appraisal panel. And from your perspective, your lender needs to help you understand the risks of structuring these aggressive offers. They need to clearly explain the impact of low appraisals, and obviously discuss what's needed from you to move everything forward with extreme confidence, especially if you plan on waiving these contingencies. All too often, homebuyers will hear, if you want this house, you have to pay the most, close the fastest, waive all your contingencies. And while we just talked about doing just that, know that less than half of the contracts that I work on are actually structured that way. But why is that? Because not every house requires that type of action. And not every buyer is capable of being that aggressive. Now, unfortunately, some buyers will fall for this advice without understanding any part of the process or any of the risks involved. You know, it's not uncommon for me to get a frantic call from a realtor. It goes something like this. John, can you take a look at this contract? It's supposed to close next week. They waived all contingencies. Our sellers were stoked. They thought it was the best offer. And now they just called us and told us they need more time and their loan might actually get denied. Our sellers are in a bind, and we need a solution. Now, in cases like that, that buyer could lose their deposit, or maybe they have to shift to some other more expensive loan option and they're forced to close into something that's very uncomfortable. You know, writing contracts waiving contingencies with big price escalations, it can add a lot of risk and cost you a lot of money if things don't go absolutely perfect. So in my next video, I'm gonna break down the tactics we just discussed, and I'm gonna highlight the personal risks of using those aggressive strategies. Be sure to watch that before you write your next offer. And also, if you have any questions or comments about anything we discussed in this video, please let me know. I look forward to seeing you in our next video.